Glen Foster from Atrium Investment Management. Welcome. Glen, can you describe the concept of risk-targeted investing?
Yeah, thanks for having me. So clients come to us with a tolerance for risk, and that might be dependent on their starting capital, their income, and their other objectives. And risk-targeted investing for us is about maximising return for that level of risk. That means when you've got a risk budget, you don't want to waste any of that risk budget on risks that won't be sufficiently rewarded, because markets will determine the return and risk of the assets that you buy. And if you've got two portfolios with similar expected returns, it's rational to take the portfolio with less risk, and that's what the risk-targeted portfolio is.
So really for clients, it's a question of having a mindset of risk rather than return.
Well, perhaps, because it's not true that return is just a function of the risk you take, because there are some risks that shouldn't be rewarded, concentration risk, for example. And also, risk and return are not static. They depend on the starting valuation of assets. They depend on where you are in the cycle. So you need to be adaptive and have a flexible enough mandate to hedge risks that won't be rewarded and to take opportunities where you can.
It seems like you're saying that clients and investors should have a risk budget, albeit like institutions. How do you get that message across to them?
Well, they should have a risk budget, a bit like how you would have a personal expense budget, because the risk of not following your risk budget is then you end up taking too much risk. And that means you might fail your objectives. You might have to accept a lower standard of living, perhaps, or change your plans.
Do you find that's a hard concept for mum and dad investors to embrace?
It is a hard concept to embrace because for investors, all they see is the outcome, the return. That's historical, and you can't change that. But as an investor, it's all about looking forward, because it's risk that's going to drive the future returns.
What about the holdings in your portfolio, a typical portfolio? Can you talk me through that?
Yeah, well, most of your return obviously tends to be generated from equities, but then you want to diversify that. And traditionally, you would use bonds to diversify, but that's not diversified enough. And this year is a case in point. You want to have other availability of other assets like commodities and loans, private credit, but also strategies that can go short as well as go long. And that's the key to being genuinely diversified.
Can you talk to the concept of preservers, growth drivers, and diversifiers, which feature quite strongly in your material?
Yeah, so growth drivers such as equities, property, as I said, they drive most of your return. Then you want to diversify your sources of return so that you're not taking unwanted risk or too much risk. And diversifiers can include other types of assets that have positive returns as well, like commodities and property and so on. But then preservers are a subset of diversifiers which tend to have positive returns or have zero return when equity markets go down. And so that's the thing that really preserves capital and allows you to build wealth over time, because you have to hold onto your capital in order to compound returns.
Glen, thanks for talking to us today.
Thanks.